don't confuse activity with strategy.
Well, that's awesome.
In other words, I'm saying contributing to a 401k if you have that opportunity is a good thing, right? But it's not a plan. So start as early as you can and get guidance. I don't care what you're doing. If you're going into real estate and you don't know anything about it, go seek wise counsel.
Hello, everyone, and welcome to another edition of Thrive and Achieve with your host, Dr. Matt Markel. Thrive and Achieve is the only podcast where professionals help professionals to succeed in career and wealth. Now, here's your host, Dr. Matt Markel.
Hi, everyone, and welcome to another episode of Thrive and Achieve, where professionals help professionals thrive in their career and achieve financial success. Today, I'm super excited to introduce Carl Pearson. Now, I met Carl at an event I was speaking at a few months ago, and we hit it off right away, as we were both looking to help working people better plan for their financial success and for retirement. Now, Carl has spent over 25 years helping people make their lives better. He started out as a chiropractor, working with athletes all the way up to the UFC and the Olympics, and we're going to talk about that in a second, and now as a retirement planner at Iron Plan Solutions Group. His own financial journey started by fixing his family's finances, something many of us have gone through, then deepened through his research in economics, markets, and risk management. Carl's specialty is turning confusion into clarity, which is very much a key tenet of what we do here on Thrive and Achieve. He's a prime example of what we're doing on this show, having professionals help professionals. He's got a great story, a ton of insight, and truly has a passion for helping people, especially those in the later stages of their careers. Carl, welcome to Thrive and Achieve.
Thank you so much for having me, Matt.
All right, let's get started. Let's jump in. Tell me a little bit more about your professional journey. How did you get to where you are today? And I want to hear about UFC and the Olympics.
Well, I started out wanting to be in the restaurant business, but then I changed my mind and decided to be a fish biologist. Then I had a mountain bike crash and became a chiropractor. So during my years as a chiropractor, I spent 22 years full time on the tables, and it's about helping people heal and live better. But I also had a background in strength and conditioning, so I got to treat and train athletes at all levels, and that was one of the things. Is I got to spend some time cornering a fighter in the UFC, actually getting to the UFC and into the UFC, and it was just a wonderful experience. And but along the way, I did realize that I hadn't prepared myself very well at all for retirement, and neither had many of my peers. So that was kind of a personal wake-up call for me. I ended up changing careers and I landed in financial services. And now I help people retire and with confidence. And I like to joke that I went from cracking backs to cracking retirement codes.
Nice, nice. Journey from figuring out that you need to do something yourself to mastering that and then being able to learn it so well, become so good at that you're teaching others. That's just amazing. So you're very successful. Was there a defining moment in your career or in your financial life that really kind of shaped how you think about success?
Well, it was more of a process. Back during the pandemic, I started reflecting on my career and my success and my retirement. You know, it was a weird time for all of us back then. By that time, I was comfortable in my job. And I'd been trading markets for about 10 years by then, but I just didn't feel good about my retirement. So then in about 2022, I went on a fishing trip on the American Patriot. It's a long range fishing vessel. And we left out of Naples, Florida and headed 12 hours west for 3 nights and fished a lot. And I got some clarity while I was out there. I just realized I had to drastically change something in my life. So once I got home, it wasn't long before I turned in my notice, and I didn't really have a plan. I just knew I was going to either day trade or do something. And I met a really good friend, Mal Mason, who is the founder of Iron Plan Solutions Group. And he's been a really good friend, and he's just a great man and very successful in the financial business. And we talked, and I took him to lunch and told him that I was going to go to work with him. And he's like, okay, you sure? And from day one that I stepped foot in that office, I've been thinking a lot more strategically and just success has become less about chasing returns and it's just more about creating freedom of time and money to pursue dreams.
Yeah, I think that when we think about the different aspects of what does success mean, and I strongly encourage everyone to go through that exercise themselves of thinking through what does success really mean to you? Freedom of time, freedom to do impact, freedom, on their finances. Those always keep coming up to the top. And I think as we think about those things, those are really ultimately what we want when we stop fixating on just a number, right?
Right. I agree.
So you focus a lot on people in their later stage careers. So we're going to talk about some different age groups here. Like, so what's, say, people in their 50s, like myself, what's the biggest mistake you see them making right now when it comes to money? So people my age, the 50s, what's the biggest mistake that we're making?
Okay, when it comes to retirement accounts, closer you get to retirement, the fewer options you actually have, and then the less time you have to recover from losses. So a person's strategies should always change and evolve based on your retirement timeline. So that's the first thing. Now, the most common mistake I see would be being concerned with accumulation without planning for the income distribution soon enough. In other words, it's one thing to grow a 401k, but to take income safely is another thing. So a lot of folks kind of treat their 401k like a piggyback, but it just doesn't come with instructions.
That makes total sense. The couple things. So one is as time moves on, you need to be dealing with downside protection, right? So that's one of the things that we need to really make sure we focus on, because we can't say like, okay, well, I've got 5 years to do it, so let's put everything in something really risky because I really need a lot more money in 5 years. So let's just roll
Exactly.
the dice and see if that works out for us, because it's a good chance it's not gonna give you the outcome that you want. So
That's right.
so on that, I think what I think people probably don't do is they see a relatively large number sometimes in their 401k, and they think that it's going to continue to grow at the same rate that they've had before. Whereas as they get closer to the time that they'll be needing the money, a more balanced approach with less of a drawdown, with more drawdown protection, is probably something that they need to be considering. And in that, the upside then potential starts to not be as great. So you have to really factor those last 7 or 8 years in, maybe more even sometimes, but let's say 7 years or so. Factor those last 7 years to basically be almost a preservation mode. Is that the way you would want to think about that, or?
Yes, you could look at it as a preservation mode. It's just you want to take risk off the table so you can guarantee how much you can have in retirement, right? So what you don't want to do is get to retirement and have the market crash and you lose your principal in your 401k. So there's a lot better strategies than that. You've always got to consider that downside risk to markets when your money is tied to the market. And the
Right,
closer
right.
you get to retirement, probably the higher percentage you need to be pulling off the table.
But still providing some sort of protection against or hedge against inflation, right?
That's right. That's right. And there are definitely ways to do that. And you can also have different buckets of money, if you will, and have higher risk in one bucket and have certainty in a different bucket. So there's different ways to play that. Everybody's strategy is different. You just have to kind of take their puzzle pieces and pour them out on the table and put the puzzle together because everyone is different, unique.
Right, right. I think what you're saying though is like some really solid advice for everybody though, is like, as you get closer to the time that you'll need the money, be worried about about drawdown effects, but also make sure that you're not going to lose pace to inflation. And then what you mentioned before, I think a lot of people don't think about is it's like when you comes times for the mandatory distributions, that dealing with those in a smart way to protect against tax consequences is a big deal.
Right. People assume their tax bracket will go down in retirement, and that's not necessarily true.
Absolutely. I think I think tax optimization is probably one of the biggest areas where people lose a lot of money. If I were to give one piece of advice to like everybody listening right now, it's like, no matter what you're invested in, whether it's, public equities, real estate, syndications, debt servicing, whatever, no matter what you're invested in, is like if you're not really optimizing for taxes, you could taking a great investment and turning that into a mediocre investment just because of your lack of tax optimization.
That's right. There's a lot of lost opportunity cost on money when you don't optimize your taxes, and you're just giving it to the IRS and you're not getting it back.
Right. So okay, then we talked about the 50s a little bit. Let's see, say for people in their 60s, is there sort of a, as they get a little bit closer to the time where they may start pulling some money out or wanting to retire or do a lifestyle change, is there some sort of like aha moment that those types of folks get?
There is. It's when they realize that retirement isn't about hitting a big number, it's about replacing a paycheck. So, in other words, they'll shift from thinking about net worth to income. And that's the light bulb moment. But that's when they say, wait, how do I turn this big pile of money into a paycheck? And that's when we get to business and build a plan.
That makes so much sense. Turning, and I love that phrase. What was it? Turning this um, pile of money into a paycheck. It's not about a number. It's about replacing the income that
That's
you
right.
that you want to have.
That's right. Absolutely. It's a different mindset once you get there.
I think that's why so many people are talking about in some of the communities that we're in. They're talking about making sure that you focus earlier on revenue streams because it gets people in the mindset of thinking about the cash flow and revenue are things that you can use and optimize and live off of, et cetera, as opposed to just, some trying to optimize for some big number. Is it, a million? Is it 2 million, 4 or 5, 10, 10, 100, whatever in an account? It's more of like, what can you use this money for and how can it service your needs for impact, service your needs for lifestyle, service your needs for whatever.
That's right. And there are a lot of strategies out there. So, it's good to speak with people and find out what's available to you before you need to know it, right? Don't wait until you're in your mid 60s to start looking for these options and strategies. Start in your 50s
Or earlier,
or earlier, 40s, start early.
20s. I mean, it's like
20s.
the
20-year-olds don't think about retirement, but you can think about being smart and you can think about actually growing generational wealth versus whatever 20-year-olds do these days.
So, okay, we talked about 50s, talked about 60s. So getting education, what's someone in their 40s? What should they be doing right now?
I think everyone needs to educate themselves. I think they should read Anti-Preneur, and I think they should subscribe to the newsletter. And I think that's a great place to start. Exactly.
This is unpaid promotion for the anti-preneur.com. But thank you, Carl. I appreciate it.
But they should. People need to read that and just understand the framework. People can go way bigger than just planning for retirement if they want, but you have to be educated to do so. Now when you have some retirement income and you get the chance, you want to lock down that retirement income with your retirement accounts. And then maybe, depending on the situation, focus on those tax efficient strategies in retirement. That way, if you're in your 40s and 50s, once you get that retirement locked down, that's when you can create the generational wealth with your salary and your habits and your ideas and your strategies, that sort of thing. So that's for those people who recognize and want to go after the generational wealth, right? That's a strategy for them. And it all starts with education. Now, some people just want to retire and hang up the gloves. That's okay too. And for those people, I would say it just makes really good sense to pay off all your debt and then save aggressively if that's what you want to do, just live out your life. People do want to have money in investments and, kind of going back to the investment conversation, what I like to do is have people compare their investments, like to the same criteria. What is your expected return on this investment? What are your risks? What's the downside risk? And what are the tax implications going into the investment and coming out of the investment? What are the expenses? What are the legal risks? Is it going to outpace inflation? There's a lot of things that it makes sense to compare any investment against the same criteria so you get a general understanding of what you're getting into. After that, think about where your income in retirement is going to come from and how much will it be. And you really need to be able to answer that if you plan to retire. And again, you can shop around because different people are going to have different answers. It's really mostly about getting intentional now. Don't wait till you're 64 to start building a strategy. And it also, back to the 50-year-olds, one of the best groups of people to start a personal pension are those in their 50s who have changed jobs and they have an old 401k. We have a way people can get a 30% bonus to their income base, guaranteed 9.5% a year toward the retirement income bucket, and have zero downside risk to market losses. Now, that is a great way to set up that personal pension in your fees so that you can know exactly what you got in retirement. And so you can go after your dreams. You don't have to risk that. If it's sitting in the market and the market crashes 50%, is it going to be 13 years before it gets back to break even? And how's that going to work with your financial plan? So when you get the chance to take money off the table and set yourself up well and guarantee some retirement income, it's not a bad play.
I'm such a fan of diversification outside of just strictly public markets. I mean, that's one thing I talk about to. I'm not an advisor, but I tell people, my friends, that's what I'm doing. I'm pulling money out of public markets in many cases, and when I am in the public markets, I'm in for certain sectors, and I think that's just wise. There's a lot of things we could talk about in terms of the institutional money and how it affects different things in the public markets is probably way beyond the scope of what we want to focus on today. But that's just it's so important to have diversification and um, having three tech stocks or having some of each of the FANG stocks or whatever. That's not diversification. And I think that if when you start thinking about these different asset classes and how they can all be producing revenue, they can all be producing or income, they can all be growing and appreciating in value, but they're on different roughly orthogonal axes of risk. And I think that that's just so smart for people, but people don't. They have like maybe a Schwab account or a Fidelity account or something like that with some uh, target year date fund, and it's got a relatively big number in there, and they think they're golden. So, and I think that that's just so. Now, I want to double back on one of the things that you said, and I think that this is. I just want to check with you. You're the expert, but to me, there is never, ever, ever a good reason to roll over a 401k from one employer to another. I've never in my mind ever found a good reason with that. Yet they all offer it because it puts more money in their assets under management. So if you're moving from a company that was managed by Schwab and your new company is now it has Fidelity management, Fidelity of course would want to take, hey, roll your money from that previous Schwab account into Fidelity here. But to me, is there any reason why anybody would ever want to roll it into the new employer's plan?
I can't think of any reason. It's a good thing to invest in a 401k when you have the opportunity to the match. But to roll it over and to keep it in a 401k when you have a chance to do something better, you probably should. And I couldn't imagine a reason to keep money in a 401k when you have access to make a strategic move that's going to benefit your retirement.
Right. It has to stay in a tax deferred account, but you can roll it um, into something your financial advisor has, not your company, but if your financial advisor has. And now you have a whole lot more options. Now you've got a lot more things than just whatever Fidelity or Schwab, whatever offers. That's number one. Number two, it offers you the opportunity for moving it into a self-directed if you ever wanted to explore that or just it gives you more options of what you can do with your money as opposed to the 15 different mutual funds that your employer's plan offers.
That's
So
correct.
that's I think some really solid advice. Thanks, Carl, for that. So I know there's always the thing comes up, Roth versus 401ks. What are your thoughts on that?
I mean, I think a Roth is a good idea. Um, I think do some of each. It's okay to have some money in a 401k. It's okay to do Roths. Roths are good. But all of those types of retirement accounts, you're in business with the government or with the IRS. There's a lot of rules to them. I think there's better things that you can do with your money than to get into Ks and Roths and traditional IRAs and that sort of thing. But I do think it's very important to think about some tax-free income in retirement as well. So I do think that's very, very important because you don't know what your tax rate will be in retirement. And it just depends on the situation on how to approach that. Depends on who we're talking to.
Yeah, and I think that seems super solid also. Everyone's situation is different. What's good for Bob may not be good for Sam or Sue or whatever. So,
That's
so
correct.
everyone needs to do their own homework on it. And it does involve nations of things. What do you like, well, how much are you going to need to spend when you're somebody who's in their 30s now, how much are you going to be wanting to spend when you're 65 years old? Like, I don't know. I think that's what bugs a lot of people is like, they sit down with somebody like their financial person and they start asking them all these questions. Well, how much are you going to spend when you retire? And they're like, well, I don't know. That's 35 years from now or 40 years from now or something like that. Um, and so they become overwhelmed and don't even know really where to start. What would be some actionable things because I know you talk to a lot of people, a lot of clients, and so forth. But what would be the first step someone should take?
I mean, if we're talking a first step, I would say start with clarity. If they feel like they're behind and they want to just get going and do it right, start with clarity, right? You need to write down and figure out what you own. What do you owe? What do you want retirement to look like? When do you want retirement? I mean, that part of it's kind of like stepping on a scale. It's not fun, but you can't fix what you won't face. So that snapshot kind of makes the fear manageable. And I mean, it gives you a starting line. I mean, for sure, you want to pay debt, have an emergency fund, and certainly have plenty of life insurance if people depend on you. But you've just got to get clear and then you got to get to business.
In the Anti-Preneur book, we talk about this 5-step program, and one of the big steps in there is you've got to know your numbers. And the what you just said here is exactly one of the things that we talk about in that. It's like you got to make your balance sheet. You got to you got to know what are the assets that you have and what are the liabilities that you have, and the your equity in your household is the difference between your assets minus your liabilities. So that's the snapshot right now. Like where do things stand today? Then you need to look at your cash flow. What's the money coming in and what's the money going out? Because I think that the that snapshot can change, but it's going to change based on most likely through the levers and knobs and so forth that you have on the cash flow side. Are you spending if you're making 250 grand and you're spending 250 grand, you're probably not going to be able to make much of a change in your asset situation unless you address one of the two things. Either make more, spend less, do some sort of different things on tax optimization, which sometimes gets tricky for W-2 employees. But just look at those two things. And then the third thing we talk about is asset protection. Like how are you protecting your assets? So but I love that concept of like just it's like stepping on a scale, right? You can't fix what you don't know about.
That's right.
Do you have like a favorite tool that you help people with on that? Or that on those, like basically just, go online, download a balance sheet, type in balance sheet into Google and get you one? Or are there some other things that you've seen that are like really good resources to recommend?
Well, I mean, there are plenty of resources out there for budgeting, and really it's just a matter of budgeting, and you just got to figure it out. There's really kind of no way around it. So you just have to budget. What Rocket Money? There's a lot of different strategies. There's there are people out there. There's a guy in Pensacola here that actually that's what he does. He helps people. He really likes to help people who are into emotional spending, but he helps people get on budgets and fix that part of it. And you just have to have control over that to have any kind of success. You're right. You can make more money. You can budget better, cut some costs, and optimize taxes. Hopefully, you can do it all.
If you're in working in your 60s, I'm probably just going to be doing fun stuff like this in my 60s. I don't feel ready to retire at all. The concept, for me, the concept of retirement, just a quick story for me. I mean, the concept of retirement always scared the daylights out of me because I take so much joy and validation about my career and helping other people and going as far as I can with what I've been given. That's just kind of the way I'm wired. And so the concept of I'll just throw it all away and start playing golf, which I suck at. I mean, it is. I definitely optimize that strokes per dollar ratio there on
Right.
on golf or gardening or something. Those don't interest me really at all. I mean, so the but but as you get in your 60s, your earning years can be a little bit more tenuous, and your lifetime horizon is starting to become a little bit closer in. What somebody should make if they're in their 60s uh, and they don't want to quit yet, but they want to do some smart things to make sure that they're just very well set up.
You need to make sure you shift from risk to reliability, where it's ultimately important to do that because, again, if your money's tied to the markets and the markets crash, how are you gonna handle that? Are you gonna pay yourself less? Are you gonna take home less income? Or is that gonna put you in jeopardy of running out? And that's really why I do this, because we've got 10,000 people a day retiring, and half of them are going to run out of their retirement account. So make that shift from risk to reliability and, protect what you've built and try to lock in some guaranteed income. At that stage, you don't want to gamble. I mean, you're in the final innings. You're not there to swing for the fences, and it's more about making sure you don't strike out. So, you don't just hope your savings will last, because that's not a smart.
So obviously, we can't give explicit financial advice on a show like this. What would be the types of alternate investments that someone should talk to their financial planner about? Would like annuities perhaps be one, or
Definitely annuities, the guaranteed lifetime annuities for someone if you're wanting to set up a personal pension, or you want to just guarantee your lifetime income and that you can't lose it because you can build a plan on that, annuities are fantastic. I just don't see how they can really be beaten if you compare that to just drawing out of a retirement account. I don't know how it can be beaten. You can guarantee it.
yeah, I think obviously everyone should A, talk to their financial advisor, B, do their own homework, etc. But I've seen some that have different benefits as well. Like whatever the amount that's in it, it might have like a multiple on that for health and for what's the term? Like
ADLs for
elderly care, things like that. So if you put $1 million in, you might get like 2.5 or 3 million in like protection against something.
That's right. Long-term care is almost unaffordable these days, and really that whole long-term care industry is a mess right now. I won't get into it, but there are some annuities out there that are aimed at growth. There's some that have growth plus the benefits. There's one that I see frequently that in case Social Security is cut and that affects your income, you can get a bonus there. If you can't do some ADLs, you can get a bonus there in case you need long-term care or assistance. And then if you don't need anything, you can have more payout, if you just want to spend the money, or you can have a much greater death benefit if you want to use it for that. So yes, there are annuities that have great benefits packages to them, just depending on what's suitable for the individual. It's just that when we're talking retirement, the very first thing I want to make sure that people have their income covered. That's just tends to be my strategy. But yes, there are many really good annuities with benefits out there too.
That I read on your website bio, I think. What is it you want people to if they retire to stay retired, right? That's
That's right.
the
Yeah. There's really two. When we retire you, you stay retired.
okay.
And then for the right people, we like to make work optional.
Okay.
So depends on who we're talking to, right? But we definitely want you to stay retired when you get ready to retire.
So in our country today, we have a $7 trillion shortfall in retirement savings. At 10,000 people retiring a day, is that what you said?
Right.
10,000. Oh my
10,000 a day.
gosh. It's just amazing. But there are going to be people that will be going back to work because they want to eat, and they just can't drop their expenses low enough to really get to the point where they're just making it anymore. And I think that's just so unfortunate because better planning early on can fix a lot of that,
It
or would have
can.
fixed.
And think about it. If you're trying to take your income out of a retirement account, So you're going to pay yourself. And there's the old 4% rule. You're not supposed to ever run out of money if you do that. But
So just to clarify, what's the 4% rule?
it's just if you have $1 million in a retirement account, then you'd pay yourself 40,000, and
Okay. So,
you'd expect it to 4%. You'd expect it to make 4%. And you should be okay and never run out of money. But what happens if the market drops 30%? Are you going to drop your income 30%, or are you going to keep spending the 40,000 and risk running out of money? You have some big decisions to make when your money's tied to market and you're trying to distribute your income that way. And not to mention now you're losing your principal because the market's going down and you're paying taxes on it. So it's just, it gets to be a really hairy scenario quickly. It just, lots of times it doesn't have to be that.
right. Okay. So I'm sure there's people that are listening to this that are saying like, this just makes me throw up. I feel fear, uh, guilt, shame. Let's say someone actually does get up the courage to come talk to you that's feeling that. How do you how do you move them out of that? How do you get them how do you address that, Carl?
I mean, I just like to reframe the story, right? You can't change the past, but you can design the future. Once clients understand that they can have some secure income, usually the fear turns to relief. I mean, it's kind of like turning on the lights and the monsters in the closet shrink real fast. But it's just facing it. It's that initial, just you got to face the monster.
Yeah, I love that. The what is it? You can't change the past, but you can design your future, right?
That's right. That's exactly right. You can't change what you've done, but you can design where you're going. And no matter where you are,
Yeah, and this doesn't get any better tomorrow, right?
that's right. That's right.
Okay. One of the last few questions. You've seen a lot. We've talked a lot about people at the end of their careers. What for somebody in their 30s or 40s, help them being in the the lower end of the savings spectrum later in life. What should they be doing now? 30s, 40s, maybe even 20s. I'll push it down to 20s maybe. But somewhere in that range. What should they do so that they don't end up later in life in a one of these tough situations that I think we all see?
I would say don't confuse activity with strategy. In other words, I'm saying contributing to a 401k if you have that opportunity is a good thing, right? But it's not a plan. So start as early as you can and get guidance. I don't care what you're doing. If you're going into real estate and you don't know anything about it, go seek wise counsel. And also, when things go wrong, don't wait for a crisis to take control of it, right? Go ahead and take control of it while you're not in a crisis. It's easier that way. And then, if you're going to, I'd say don't binge on Netflix too much, right? You're probably better off to binge on compound interest. I mean, that series will pay you back. Netflix won't. So just be intentional, think about it, seek guidance, and know what you need to know before you need to know it. Be proactive.
I love that. Don't confuse activity with strategy,
That's right.
and use the time that you have in your 20s and 30s and 40s to get the education you need so you can be the smart consumer, so you can be the smart investor, so you can be the smart employee, so you can thrive in your career, of course, but also then you can be making the smart financial decisions.
That's right. It's rare that ignoring it helps. And you got a lot of people with their head in the sand out there. And I'm just pulling as many heads out of the sand as I possibly can.
Yeah, and thank you for doing that. Okay, thriving and achieving. What does thriving and achieving look like in your own life right now? Let's talk about you for a sec.
For me, it's about balance. I mean, it's about spending time with my family, and it's about serving my clients, and then still having the energy to enjoy life. And thriving means I'm not just building wealth, but I'm building memories and I'm living a meaningful life. That's how I feel.
Awesome. What's one piece of career advice or financial advice that you think is just completely wrong? Let's bust some myths out there.
I would say, um, the advice along the lines of just keep saving and it'll work out. I don't think you can save yourself to wealth. I don't think it happens that way. Saving that's not a plan. That's hope. Again, you're hoping, and I don't like to use hope as a retirement strategy. I mean, it's like telling somebody to keep running without telling them where the finish line is, you know?
If you could teach every professional, remember we're professionals helping professional, just one lesson on money and one lesson on career.
Okay, well, money, I would say protect your downside. Losses can hurt more than gains help. So definitely protect your downside. And then as for career, I would say do meaningful work, because I mean, fulfillment's the real dividend. It's just that you got to make enough money. So do meaningful work as long as it makes enough money.
Right. I think we all want to work on something. Well, at least many of us, me for sure, you for sure, we want to work on something that's bigger than ourselves. And finding that and structuring it such that it's lucrative for your family, lucrative for, so it gives you the financial freedom or the financial means that you can then pursue financial freedom. That's the winner, right? Work on something bigger than yourself and make it and be smart with how you're compensated with that so that you can then use those proceeds and use that income for smart things to basically set yourself up, set your family up, perhaps set up generations in wealth. Carl, thank you so much today. You've given us a ton of stuff to think about. I think we all need to be probably calling up our financial advisors now with some new ideas that you brought forth. Some people might be wanting to call and even just find a financial advisor. If somebody wanted to get in touch with you, what's the best way for them to do that?
Well, the best way would be to email me. Email me at Carl, Carl, at myironplan.com. That's Carl at myironplan.com. And you can check out our website at myironplan.com. So
Okay,
check out and see who we are and what we're about.
good, good. Well, thank you so much. Uh, Wonderful having you on. A ton of super valuable advice. Everyone else, thank you, and we will see you the next time on Thrive and Achieve.
Thank you so much for having me.